Hello and welcome everyone. I hope all of you are doing good. A very warm good afternoon. My name is Harshmeet Singh and you are watching us live at Narayana IAS Academy. If you have been watching this series over the past few days, you know what happens here. Every single day we have this session at 12 where we discuss the most important current affairs related articles from economics specifically. We have covered a lot of articles so far, a lot of topics, and discussed important practice questions as well regarding each and every one of those, along with related previous year questions from the prelims examination as well. In case you have missed out on any of the earlier classes, please do yourself a favor, make sure that you go to this entire playlist and see all the earlier classes that we have done so far. This is class number 11 of economics, so there are 10 more classes that we have done before that. Also, if you are one of those who is thinking that my year of attempting the examination is not this year, if you are planning to attempt the examination next year or maybe beyond that, you don't need to worry. For you also, we have multiple programs lined up for you here at Narayana IAS Academy. We have a 1 year and a 2 year complete program which covers your preparation for all stages of the examination. Starting from the prelims to the mains and till the stage of the interview, we will be holding your hand till your dream is achieved. So make sure that you do check out all these courses. If you want any information about any of these, please check out the description of this video. You will find a link there which contains all the information about these courses. So make sure that you do that. In case you have any questions regarding that, feel free to contact us. We'll be happy to assist you. All these courses that we offer you would have dedicated classes for current affairs. There will be a lot of focus on mains answer writing, prelims practice papers, and everything that you need to clear this examination. So make sure that you do not take a lot of time. If you have to start your preparation for next year, this is the ideal time to get yourself into that cycle now, because if you don't, it might be too late. On that note, let's begin and let's see what are the topics that we have lined up here for you. We have discussed a bunch of topics so far. The last few topics that we have been discussing, if you have been following these classes, have been from banking sector. We'll continue with that, and we have a bunch of other topics from banking sector to cover. First, the topic that we'll be covering today is RBI's draft rules for payment aggregators. Now, what are payment aggregators? Who are these companies and what do they do exactly? You would notice that, for example, when you go to a shop, you buy something, you go to a petrol pump to get petrol or diesel or whatever. In most of the cases, for example, let's say if you are paying from your credit card or debit card, you swipe your card on that machine. That is called the POS, or the point of sale machine. Now, that machine is owned by a company. That company, for example, becomes a payment aggregator. One example is that the machines that are owned by those companies, or the companies that provide these machines. Second example can be, let's say you go to a website and you are buying something from that website. You may be redirected to a page that may be owned by, let's say, a company, let's say Razorpay or CC Avenue. What are these? These again are payment aggregators. They are payment gateways that have come in between. What they do is they make sure that when a company has just opened up its operations and an organization has to accept payment from its customers, they provide this facility. They come in between and they say, you don't have to worry. We will collect the payment from your customers. We will charge a small fee for that and we will transfer the rest to you. That is how it works. These are called payment aggregators. Now, payment aggregators increasingly form an important part of the entire business ecosystem, because most of the money that the customers are paying to the companies from where you're getting the product actually is going through the payment aggregator only. So payment aggregator has to be a company that is working in a trusted manner. For example, think about this. Let's say I am an organization that has occupied, or I am an organization that has actually, let's say, involved any of these payment aggregators. Let's say I contact Razorpay and tell them that I want your organization to come in and be a payment gateway. If Razorpay comes in between, that means my customer is paying to Razorpay and Razorpay has to then transfer the money to me. So I have to have complete trust in Razorpay in that situation. I have to trust that whatever money my customer gives them, they will be giving it to me. This is where the RBI obviously looks into the working of the payment aggregators. They look into whether they are trustworthy or not. And now RBI has made sure that there are strict rules and regulations about them. So now RBI has released a new set of guidelines for payment aggregators especially. This is what we are here to discuss. These kind of questions are very commonly asked in the prelims examination. The new guidelines for payment aggregators, how does it work, what is it that they have to do. If a new company has to enter this field, if a new organization has to work as a payment aggregator, then what do they have to fulfill? It's similar to having a banking license. If you want to open up a bank, for example, there are a set of rules and regulations that you have to follow that are given by the RBI. You have to have a minimum paid up capital, you have to follow the rules of RBI with regards to how much loans can you give, in which sector can you give. Similarly, similar to that, the payment aggregators also, since they are an essential part of this entire payment cycle, this payment ecosystem, they also have to fulfill the guidelines given by the RBI. Now, what are these guidelines? What is it that the RBI is telling them? This is what the topic is. So, first of all, who are payment aggregators? I told you earlier, these are the companies that come in as an intermediary between the organization, between the company and the customers. See, it's not that you need to have these. For example, when there are very, very big companies, let's say Facebook, Google, if you are paying money to Google, if you are paying money to Facebook, for example, they might say that we will do our own programming, we can have our own integration of banks, we can accept payments directly. But in a lot of other cases, when a company, there's a startup, they don't want to get into all these hassles, they just want to have a system where they can accept payment from the customers in an efficient manner. This is where the payment aggregators come into the picture. So again, these are of different types. They can be those that give you the machine, the point of sale machine from where you can actually swipe your card, and they can be of other kinds as well, where they act as a payment gateway between the customer and the organization to which the customer is paying. Now, these are the two different types, as I told you, depending upon which channel you are using to buy your product. It can be an online payment aggregator and it can be an offline payment aggregator, more commonly known as point of sale or POS. Those machines, credit card or debit card swiping machines, those are called POS machines, point of sale. So that is an example of offline payment aggregator. So the online ones, the most prominent ones, the examples that I gave you are Razorpay, then there's Cashfree, CC Avenue, PayU, all these are examples. Again, you can see them when you're doing some online transactions on different websites and you're paying them a certain amount of money, paying them certain fees. You might be redirected to one of these websites and you will see their names there. So what they are doing is they are integrating their entire system. They have told the companies that we will collect the money, we will give it to you. You don't have to set up or have partnership with banks or Mastercard or Visa, we will do it for you. Then there are offline merchants that need their own swipe machines, their own ecosystem where they can take payment from the customers easily. This is where the companies come in the form of point of sale. These are like Paytm, for example. Pine Labs is a famous one that has come in now. These are white colored machine, the POS machine, basically white colored, and you can swipe your machine or card there. You can very commonly see them on shopping malls, any offline store that you go to, petrol pumps, etc. This is where you can see them. Both of these come under the category of payment aggregators only. So both of these have to abide by the rules that RBI has given. Now, what exactly are these rules? Let's get into that, because that is what is relevant for the examination. What exactly are these rules? What is it that they have to follow? First of all the existing and new payment aggregators, so even the ones that are existing and the ones that are new, will need to obtain authorization from RBI by May 2025 to continue offering these services. So even if you are an existing aggregator, means you have already been working, or if you are a new aggregator, you want to enter this field now, both of these will have to take authorization from RBI so that they can continue their business after May 2025. So post May 2025, you still have to offer these machines or you have to launch a new business, a new entity in this field, RBI's authorization is required. Second, if you are an existing payment aggregator, you need a minimum net worth of 15 crore to apply for RBI authorization. So if you're an existing company that has been working in this field, you need to have a market cap, you need to have at least 15 crore rupees of worth so that you are stable enough and there are no chances of you actually taking the money away. Apart from that, By March 2028, all the existing and the new payment aggregators must have a minimum net worth of 25 crore. So it's a pretty steep target if you look at it. The existing ones have to touch or should be at least 15 crore minimum worth by this year when they actually apply for the authorization, and within next 3 years, that is by March 2028, their net worth should touch 25 crore. Apart from that, RBI also says that they must become members of Financial Intelligence Unit (FIU) to report suspicious transaction. Now, FIU or Financial Intelligence Unit is a part of a much bigger global platform. So, FIU, for example, works very closely with the FATF, the Financial Action Task Force, that's a global body, to look into whether or not the money that is coming in through various channels, is it being misused, or is it going to wrong channels, is it going in the wrong hands or not, is it being misused or not. This is where it comes in. So, all these payment aggregators have to become members of FIU. Apart from that, there are enhanced security measures that have become mandatory to prevent fraud because of these transactions. Now, you would have seen a lot of videos and a lot of news articles also about a large number of frauds that are committed using those machines. Someone swipes it and the information that is on your card may be shared with someone else. That is why you would see most of these POS machines now, what they do is they don't have a set pattern of the digits. When you have to enter your code, you might see they don't have it in the set sequence of 1, 2, 3, 4, 5, 6, 7. They are randomly generated. So 3, for example, might be at the bottom, 7 might be at the top, 5 might be somewhere else. That is done specifically to avoid someone else looking into you or looking into you entering your password, so that no one from far away can ascertain what exactly are you typing on that machine. These are one of the security measures. Then if you would also notice, most of these POS machines have their keypad slightly hidden. So there is a slight blocker there, so that when you are typing something, the person standing on the other end, a person standing on the side of you would not be able to notice what exactly are you typing. These are enhanced security measures that have been put into place. RBI has made some of these mandatory for POS. Those who give, again, POS means those machines using which you swipe your card. So RBI has made some of these features mandatory for them. Again, the intention is to make your transactions safer, so that someone else could not know what exactly are you typing, what is your password. Apart from that, there are certain other compliance guidelines that have been given. They have to be fulfilled within a certain deadline. For example, the existing payment aggregators have 3 months from the final rules to comply with the guidelines in areas such as merchant onboarding, complaint management, etc. RBI is extremely strict this time around about whether if they face certain fraud, if there are certain suspicious transactions, RBI wants them to be reported in a timely manner without any delay in such cases. Any company that is non-complying with it will seize the POS payment system, and the banks will close their account by October 2025. So again, there is a mandate set that if you don't fulfill this, you can say goodbye to your business and the banks will close down your account, so you will not be able to access the money that you have there. All these guidelines are applicable equally to all the payment aggregators and online aggregators as well. So it doesn't matter if you are an offline aggregator, means you gave these swipe machines, or you are an online aggregator like Razorpay, CC Avenue, etc. These guidelines will apply to both of you. Both of you will have to be very careful, especially about any suspicious activity, about any fraudulent transactions that you see on your portal. You have to report them to FIU in a very timely, time-bound manner. Apart from that, there are new KYC norms as well. KYC, as you know here, stands for Know Your Customer. So for example, when you go and open up a bank account, or even when you go and buy a SIM card, there is some documentation that is asked of you. You have to give some ID proof, you might have to give some address proof. That is a form of KYC, Know Your Customer. So the bank has to know the customer first before giving them their services. Similarly, while KYC is already mandatory, regulations have extended the scope and make the provisions even more nuanced. So many other details would be required. It can't just be a random document submitted. RBI's proposed instruction, they categorize merchants into small and medium merchants. So there are different types of merchants depending upon what the size of their organization is. Depending upon that, RBI has given these guidelines. So if you actually notice what is happening here, RBI is putting the onus of preventing and reporting the frauds on these payment aggregators. Rather than the RBI telling the organizations that you have to report this, RBI is saying that, okay, I don't care what the organizations are doing, because you are the payment aggregator in between. You are the one who is handling the transactions of money going here and there. I put the responsibility on you. You have to tell me if something fraud or suspicious is happening here. This is what the RBI is doing with these new set of guidelines. These are the new KYC norms. As I told you, for small merchants it's separate, and for the merchant it's separate. So let's see. For small merchants means those who would constitute, who are physical merchants whose annual business turnover is less than 5 lakh. So small merchants are those whose business, all the turnover, that means all the selling, all the buying, all of that does not go above 5 lakh, who are not registered under the GST. So they don't have a GST, because see, GST is not mandatory for those whose turnover is less than 20 lakh. You can take GST even below that as well, but GST becomes mandatory when your turnover touches at least 20 lakh. So for small merchants whose turnover is less than 5 lakh and they are not covered or they have not registered under GST, they are called as small merchants. They also have to verify their bank accounts in which the funds are settled. Then the medium merchants, that is the higher category. Those are the ones who are physical or maybe online agent, but the annual turnover for them should be less than 40 lakh. And again, they are not registered under GST. They would also have to undergo the contact point verification. Means if they don't have a GST registration with them, they would have to then get themselves verified with those companies who are offering them these payment gateway services. All these, again, I'm underlining the fact that all this is being done so that the RBI can make it more and more difficult for these frauds to go unnoticed. The responsibility of preventing, or if not preventing, then reporting these frauds has been put on these payment aggregators. Not just the new ones, but the existing ones that have been working earlier as well. They would have to comply with these and they would have to fulfill certain guidelines that have been given here. This was our first topic for the day. I hope all of you understood that. If you did, let's see if you can answer this particular question. Read this carefully, make up your mind and decide the answer in your mind, and then we can discuss this. Read this. Got it? If you need more time just in case to read it and make up your mind, feel free to pause on this screen and then maybe make up your mind, decide what is the correct answer, and then you can play again. Okay? Let's see. With reference to Reserve Bank of India's draft rules for payment aggregators issued in 2024 April, consider the following statements. Number one, non-bank entities providing physical point of sale services must have a minimum net worth of 15 crore at the time of applying for RBI authorization. So what they are trying to say is, see, those swipe machines, the credit card, debit card swipe machine, they are given by banks also. So SBI, PNB, HDFC, they also have these kind of machines. They might also give it to the merchant. The RBI is not talking about them because banks obviously will have a net worth of over 15 crore. So we are not talking about them. RBI is saying that non-bank companies, so the companies that are like Pine Labs, etc., Innovati, these companies that offer these POS point of sales machine, those are not banks. For those companies, when they apply for RBI authorization, their minimum net worth should be at least 15 crore at the time of applying. Yes, absolutely correct. Apart from that, there was one more point, if you remember, I'll remind you once again. Apart from that, their minimum worth should become 25 crore by March 2028. So not only it has to be 15 crore at least by the time that you're applying, it also has to reach 25 crore by March 2028. So first is absolutely correct. Second statement, the draft rules prohibit the storage of file or card on file data by any entity except card issuers and networks for face-to-face transactions from August 1, 2025. This is also correct. So the data that you share, the the credit card data or debit card data, let's say you are ordering food, let's say from Swiggy, Zomato, etc., or you're booking a cab on Uber. The card data that you give it to them, a lot of that is sensitive data. They are not allowed to save that. They're allowed to save only a bit of it. For example, they are sorry, you enter your CVV, that is a 3-digit on the back of your card, but they're not allowed to save it. Only entities that can save that kind of sensitive data are the issuers, the card that has issued it, or the networks for face-to-face transaction, but apart from that, others can't share that. That is correct. Third, banks providing PAP services, payment aggregator services, are exempt from seeking separate RBI authorization, but must comply with regulations within 6 months. Now, as I said, these machines are given by banks also. If HDFC or if SBI is giving those machines to a customer, do they also have to ask separate permission from RBI? No, they don't have to ask for separate permission from RBI. So they are exempt from seeking separate authorization. This part, until this is correct, if the statement would have ended here, then it would have been the correct statement. However, it continues to say, but must comply with regulations within 6 months. This part is wrong. They must comply with regulations within 3 months. That is why it's so important to read all these statements carefully till the very end. If it would have been half of this statement, then it would have been correct. The statement would have ended here, that they do not need a separate RBI authorization. That was correct. But because they added the fact that but they have to comply with RBI regulation within 6 months, that part is wrong. It is 3 months of time that they get to comply with these regulations. So that is why third goes wrong. Fourth, the draft rules categorize merchant into small and medium, with small merchant defined as those with an annual turnover less than 5 lakh and not registered under GST. Yes, absolutely correct. This is what we had discussed. One more addition, I remind you, for the medium ones, what was the turnover limit? For the medium merchant, the turnover limit was 40 lakh in a year. So by that logic, 1, 2 and 4 here are correct. So the answer here becomes A. A is the correct answer here. I hope you got this one right. Slightly tricky, but you can expect these kind of questions in the prelims examination very, very, very easily. A becomes the correct answer here. If you want to take a screenshot, you can here. If you want, you can take a screenshot here. You can, if you want to revise it later on, that can be helpful for you. Done? All right then. The next question that I have, again from the same topic, let's see if we can answer this one. Read it carefully and think of what the answer should be here. Think about it. If you need more time, as in the first question, you can pause on this screen, think about what the answer should be, lock it in your mind, and then you can play again. All right then. So, consider the following statements regarding RBI's draft rules for payment aggregators and their implications. Before we go further, I would remind you once again, it says which of these are not correct. Okay? Do not ignore this part. I've been telling this to you in the past few days. A lot of UPSC questions might be formed in such a manner that they would be asking you the incorrect statement and not the correct one. So do pay attention where you have to choose the correct or the incorrect. So this is where they are asking you the incorrect statements. First, non-bank payment aggregator entities must notify the RBI of their intent to issue or to seek authorization within 60 days of the issuance of the final circular. Means when the RBI now has released a circular, if those who are actually entities that are not banks and they want to start this business, continue this business, they have to inform the RBI within 60 days. That is correct. Within 2 months of release of these guidelines, they would have to tell RBI that yes, we wish to enter this, so that the RBI can be in touch with them. Second, The draft rules mandate that all the existing merchants undergo due diligence by September 30, 2025 with quarterly compliance reports submitted to the RBI. That is also correct. All the existing merchants that have to continue with this business, they would have to come under the scanner of the RBI once again. There would be due diligence every quarter so that all the reports are published with the RBI. Third, the rules allow cash on delivery transactions to be routed through escrow accounts maintained by PAs. No, see, cash on delivery transactions, they are not a part of this payment aggregator system. Think of it from the side of the merchant. Let's say I am a merchant, I run a shop, and a customer came to me and the customer is giving me cash. Why would I then all the way get it through payment aggregator? Because understand, payment aggregator is charging me some commission for all the business that they are doing. Every payment that is given to me through those machines when someone swipes their card, I have, as a merchant, I have to give 1.5 to 2% commission to these payment aggregators. So if someone is paying me in cash, I would be happy. Why would I get it through the payment aggregator then? That is why you will go at a lot of shops where people say, or the merchants will say, no, don't give me, I don't have a card machine, give me cash. Now they're opting for UPI as well because UPI, at least for now, doesn't have a commission. But the reason why a lot of merchants would not like or would not appreciate you swiping the card is that card machine or swiping the card would mean that they would have to give a part of the money as a commission to payment aggregators. So cash on delivery would not come through payment aggregators because when it is cash, why is it that someone else or the merchant would actually put it through the payment aggregator? As per Economic Survey 24-25, the draft rules are projected to increase digital payment volumes by 25% by 2028, which is wrong. So Economic Survey says that these rules may give a push to digital payment, but it does not tell that it will be 25% increase or this much increase. No, that is not what Economic Survey talks about. Since you had to tell which of these is not correct or wrong, out of the 4 statements, third and fourth are wrong. So the answer here becomes A. Since you had to choose the incorrect ones, A is the answer. 3 and 4 here are incorrect. Others here are absolutely true. If you want, you can take a screenshot here as well again. It will help you revise later on. Okay. Now I have a related previous year question for you. This is a question about RBI that was asked in prelims examination in 2012. So related to this, if you think you can answer this, let me know. Not a very difficult question to answer. Think about it. The Reserve Bank of India acts as a banker's bank. This would imply which of the following? So the RBI is called the banker's bank, and when we call it a banker's bank, what does it mean exactly? First, bank retains their deposit with RBI, yes. So the banks in the form of cash reserve ratio have to maintain some deposit with the RBI. The RBI rather, lends funds to commercial banks in the time of need. Yes, they do that. There are different ways. Repo rate, bank rate, marginal standing facility, all these are options available through which the banks get money from the RBI. RBI advises the commercial banks on monetary matters. Yes, they do that. On which sector to give the loan, how much money should they have with them so that they can be sorted if there is a financial loss in the future. These three, all of three are correct. Answer here would be D. Answer here would be D. Pretty simple question to answer, asked by UPSC in the 2012 examination in prelims. Got it? Great then. Moving on to the next topic. The next topic that we have here is called the sovereign green bonds. Let's try and understand this. First of all, let's get to the idea of bonds. What exactly are bonds? Now, bonds is one of the simplest ways for the government to raise money. Let's say the government of India requires certain money for, let's say, building infrastructure projects or a new scheme that the government has launched. For that, they require money. Now, how does the government get money? Either they can, let's say, go to institutions such as the World Bank. They may go to institutions such as the Asian Development Bank, ask for the loan. Third or second option, they may ask the RBI, print some money for us, but that will lead to a lot of inflation, so that is also not done. Third, the government of India can take loan from within the country. That is called internal borrowing or internal debt. For the government to take internal debt, that is debt within the country or loan from within the country, government bonds are the easiest way to do that. So, for example, the government will ask the people that do you want to invest in the government or not? Let's say you have some money and you're thinking of where to invest, where can I grow this money. Let's say you have 1 lakh rupees. Okay. The government tells you that you give me 1 lakh rupees. In return, I promise you I will give it back to you after 2 years with an 8% rate of interest. So your money will grow with me, 8% every year it will grow, and I will give it back to you after 2 years. When you give the money to me, I will give you in writing all the details that this is the amount of money that you have given, this is the interest rate that I will give to you, this is the maturity date, this is when the money will be given back to you. A document will contain all of that. That document will be called a bond. So what you are doing is you are buying a government bond, and buying the bond essentially means that you are loaning the money. You are giving your money to the government. The government is taking a loan from you, which the government shall return to you at a future date. That is how the bonds are. Now, the bonds are nothing new. If you remember, we did discuss about something called masala bonds. A couple of days back, we discussed what masala bonds are, how are they helpful, why is it that they are used by business organizations. It was in the news because HDFC issued a significant amount of masala bonds on the London Stock Exchange. So, this is something that is not new. However, what has happened is in the past few years, every country in the world, including India, is focusing a lot on sustainable development. We are focusing a lot on renewable energy. You know that India also has announced that India will become net zero or will achieve net zero by 2070. Remember? That means the amount of emissions that India creates, at least that or even more emissions will be absorbed within the country. We will have this much, let's say, carbon sequestration within the country so that all these emissions are absorbed. So, we aim to achieve net zero by 2070. In order to achieve net zero by 2070, the government gave an estimate. The government said, if we have to achieve net zero by 2070, we need at least $10 trillion, trillion with starting with T. This is the government's estimate that to achieve net zero by 2070, we need at least $10 trillion with us. Only in that scenario would we be able to achieve that. Now, how does the government get so much money? One way is that developing countries around the world, including India, are demanding that the money should be given to us by the developed world. Why? Because around the world there is an understanding that climate change is a problem that started because of the developed world. It was a developed world who started industrial revolution in the 18th century, and it is well known and well proven now that the increase in the global temperature actually started when we started with industrial revolution. Before industrial revolution, whatever the global temperature was, that is seen as the base temperature, and when we say that the Earth's temperature should not increase by over 2 degrees Celsius, what we are comparing with is as compared to pre-industrial revolution era temperature, as compared to that our temperature should not go beyond 2 degrees Celsius. That is the government's idea, that is what the entire world is aiming for. Now, coming back to the problem. The problem is if we have to move towards this, if we have to move towards renewable energy, we require a lot of money, and that money is about $10 trillion. So, one option we are asking from the developed world, and obviously they are not ready for it. See, logically speaking, why would any country give so much money to some other country? Everyone says it's their own fight. We can help you with some money, but you should not expect so much money from us. The other option that now the government has is raising money through something called sovereign green bonds. Green bond means money that is coming in through this will be used for sustainable energy or will be used for sustainable efforts. That is to achieve our sustainable development goals, to improve our renewable energy potential, etc. Sovereign, the word sovereign, when this gets added, that means these are issued by the government. These are not issued by any private entity. So when the government issues these bonds to raise money specifically for renewable energy project, that is called sovereign green bond. That is the basic idea. Now, why are these named like this? Why is it that government cannot just issue common bonds? Because first, there are a lot of people in the society who, for example, would think that I want to do something for the environment, but I don't know what to do. This is the government telling you that you have a chance now to make a difference. This is the government telling you that if you for a long time thought that I have to do something for the environment, but individually what can I do? I don't have an option. This is an option for you. You give us the money, we will make sure that we are using it for the benefit of the environment. So the government of India has started issuing sovereign green bonds now. That is, again, the idea is that we will transition towards a low carbon, a low emission economy. The problem, however, is against what the government expected, contrary to what the government expected, there is not a lot of interest from the people. There are not a lot of people who are lining up to buy these bonds. Now, why is it so? Think of it from the investor's point of view. If I am an investor and I want my money to grow and I'm looking for different opportunities, okay, I will not go to the banks interest rates are declining. You might have read in the news HDFC has just slashed down the interest offered on the saving bank account to 2.75%, which is the lowest in the last 40 years. So giving your money to the banks in the savings account doesn't make sense because it will not even beat inflation. So as an investor, I am looking for opportunities to invest. But the problem here is the green bond that the government is issuing is not offering me a very attractive rate of return. If the government really wants people to bring their money here and bring the money, give it to the government to be used in these kind of projects, they have to make it worth their investment. They have to make it more attractive. This is something that the government has not been able to do. The rate of interest that the government offers on these bonds are called as greenium. So it's a word play on premium and green, so it's greenium. Greenium means the percentage return that is offered on these kind of bonds. So in India, when the government is issuing these bonds, they are not offering a very good greenium. They are not making it attractive enough, and that becomes a big problem. These bond instruments, these are other features. First, exclusive use. As I said, the money that is raised here will be exclusively used for the purpose of fighting in the interest of the environment. You know, it's similar in that way to cess. You would have read about cess, for example. Cess is the money that the government collects from the people on certain transactions, which is very specifically used for a purpose. For example, earlier we used to have something called education cess. There was Krishi Kalyan cess that was used for agricultural purposes. So just like cess, which have to be used for a very specific pointed purpose, the money coming in from green bonds also will have a specific purpose where it will be used. Then lower yield, as I told you, in case of bonds, the interest rate that is offered is considered as yields, or you can call them as yield. So the yield that is offered to them are lower in India as compared to others. Now, this is not with every country. See, a nation, the government, when they are issuing the bonds, they decide what is the rate of interest do they have to offer. Like for example, if you look at many European economies are also issuing these green bonds. It's not just India that is doing it. The difference here is in Europe, when the European economies are issuing these bonds, they are actually making the interest rates more attractive for the people to come and invest. So in Europe, it is much more attractive to invest because the offer at the bond yield that is being offered is much better. In India's case, that is not true. And this is where the problem starts. So in India's case, the bond yields are lower. You will have a green certificate also. The issuers of the bond, that is the government, will offer this certificate to prove that yes, I have used this money in green projects only. There will be periodic reports about where the money is being used, and it can be traded as well. This is important. So these are tradable bonds. For example, let's take this situation. Let's say I gave 1 lakh rupees to the government, okay? And the government said, come back to me after 2 years, I will return 1,20,000 to you. I said, fine. Now all of a sudden something happens in my life and now I can't wait for 2 years. I have to get my money in between, but I can't go to the government. Now what happens in this case? In this case, if I can't go to the government, I can't wait. I will find someone who can buy this bond from me, give me the money right now, and I'll give the bond to him. That means it is tradable. So I will tell him that the bond is worth 1,20,000. You have to just wait for some time. The government will give it to you. But in return, give me some of the money right now. So then there's a negotiation at what rate will you sell. But the bonds are tradable. Means the government doesn't say that I will give the money back to only that person who bought the bond. That doesn't really matter. You can sell the bond to someone else. The government will give the money to them as well. So these are tradable as well in the market. These are important because again, this solves a big problem. The problem of what we call as climate financing. See, climate financing is a big issue around the world. Multiple climate change summits have taken place, multiple UNFCCC summits have taken place, where the countries just come and discuss and talk about how we should raise money, where the money will come from. We also have something on loss and damage fund now. We used to have GFC, the Green Climate Fund, but nothing really concrete has come up. There is no concrete mechanism under which the developed countries promise that a certain amount of money every year will be given to developing world. That has not happened. Basically, the developing world has been told that it is upon you, you decide how you have to raise the money, no one else is coming for your help. This is where the countries have decided that it is time that they have to take the matters in their own hand and start with these kind of things. So globally also, as I said earlier, globally also other countries do that. For example, China, US, EU, all of these have been issuing these green bonds. Now you might imagine that EU, US, they already have so much money. Why do they need money from the people? Because again, that is how the governments work. If the governments think that they can take money from the people, they would be willing to do that. And also, taking money from the people, when the government sells a bond, it is also a way to control inflation. You would have read the inflation. The basic idea of inflation or the basic assumption is when people have a lot of money in their hands, that is when the demand increases. And when the demand goes up above a certain level, that is when inflation begins. So to control inflation, the governments, the central banks withdraw liquidity from the market. And what better way to withdraw liquidity than to sell these government bonds so that you take money from the market hands, from the hands of the people, give them the bond. So these are used for different purposes, controlling inflation, raising money for climate change activities, etc. So it is used by all these. The difference is, as I told you earlier, that in India, unfortunately, the rate of interest or the bond yield that is offered is not very high, which in turn means it is not attractive enough for the investors to bring their money in. On the other hand, in Europe, for example, it is 7 to 8 percentage point. That is much better. In case of India, 2 to 3 basis point. Now, this is, again, it's difficult to know, or it's difficult to imagine why would someone invest their money for bond yield which is 2 to 3 percentage points. That doesn't even beat inflation. I would at least want my money to grow at a higher rate than inflation. If I get better rate of interest than this just by putting my money into the account in the savings bank, why would I go ahead with this? The only thing that the government here is hoping for is government is trying to basically push people who have this conscious that I want to do something good for the environment and they don't have a way to do it. So government is appealing to that particular group of people who would think that I want to fight against climate change, but I don't know what to do personally. Nothing is in my hand. To them, the government is saying that give us the money and we will invest it. But it is not really something that will attract genuine investors who are looking to grow their money specifically. This is the history of sovereign green bonds that we have in India. It's not very old. It's a very recent introduction in the government, in the government's efforts to raise more money. So this was launched in budget 2022-23 to fund green projects specifically. And again, this is an idea that we took from other countries. Other countries are also doing it, China, EU. So we thought, why not we also try this and we also can raise some funds from here. So there are many initiatives under which or where the money is spent here. For example, metros, renewable energy. The money that comes in is managed by Ministry of Finance and it is audited by the CAG. The CAG will give an audit report about how much money is used where, is there something wrong happening or not. it is eligible for trading and discounted under the SLR norms. SLR norms, what does it mean? It means that the government is not just saying that the common public can buy this. Why just common public? The banks can also buy this. See, if you are, let's say, SBI, Bank of Baroda, HDFC, whatever, you have a lot of cash with you. You also want a way in which the cash that you have with you grows. And this cash can grow if you can actually put it into somewhere where you can earn a rate of interest. So government is telling the banks that you can buy these bonds. They will also be counted as SLR. You know that apart from CRR, cash reserve ratio, which is cash amount that the banks must keep with RBI, there's also a requirement called SLR, statutory liquidity ratio. That means this part of money, this amount of money in the form of either cash or gold or government security, etc., has to be kept by the banks with themselves, again to ensure their liquidity. So the banks have to anyways maintain a certain amount of government securities. So government says that when you even have to maintain it, why not buy these bonds only? Because when you buy these bonds, the green bonds, they will be counted as SLR under SLR norms. This is again the government's way of making these bonds more attractive, at least for the banks, so that the banks can buy it and the government would not just expect money coming in from individuals. This is how funding allocation of the green bonds was done, the money that came in. This is for financial year 24-25, meaning the financial year that ended on 31st of March 2025. In that financial year, this was the allocation. Bunch of money or bulk of money, if you see, has been put on electric locomotives. Why? Because a lot of our trains were still run on coal. So we are moving all the trains away from coal, and we are making sure the train runs on electricity that can be generated by hydropower, etc. So bunch of money went to electric locomotives, then 8,000 crore for metro project, then renewable energy project like green hydrogen mission, etc. Then some money went to afforestation as well. These are allocation. Again, you don't have to remember these allocations, not the exact number. I told you earlier as well. There is a higher probability, or there is a better probability of the UPSC asking you a trend, not the exact number. So UPSC may ask you that in which of the four highest allocation was made from the green bond. They will not ask you how much allocation was made. They'll ask you in which of these the highest allocation was made. So as long as you know that highest allocation was electric locomotive, you are sorted. You don't have to remember how much. So the 12,600 number is not important. The fact that this is the highest data, or this is the highest item, that is what is more important here. There are certain challenges because of which this sovereign green bond idea has not really picked up pace as much as the government would have wanted. And again, it all comes back to the fact that this is not attractive enough for the investor. Think of it from an investor point of view. Why would I bring my money to government bonds or green bonds especially if I can earn a much better premium somewhere else? When I know that my money is not even growing at the speed of inflation, there is no point of anyone bringing their money here. So very low premium, liquidity issues means the bonds that are being issued here are not very easily tradable on the secondary market. So even if I, let's say, buy this bond of the government and I wait for 2-3 years, in between if I have to sell it to someone on the market, it's very difficult. These are not like shares that are just easily sold in the market day on day after day. These are not that easy to sell. So your capital gets locked up, means they are not that liquid. When you say an liquid asset means something that can be sold very easily. Like gold is a liquid asset. If you have gold, you will find a bunch of people who are ready to buy it. But these bonds are not that easy to sell. Foreign investor hesitation. The foreign investors are not that upbeat about that. But again, it comes back to the fact that it doesn't offer a lot of incentive to them. Slow reporting, there is delayed fund allocation that does not really impact, that does not give them a lot of confidence, meaning that if the government gets 10,000 crore from the bonds today, they might use this fund after 6 months. So there's not a lot of confidence in the people that what is it that the government is doing with these funds for such a long time. So the allocation of the funds is done much later as compared to when the funds are given to the government. Then there's dependence on general revenue as well, means if the budget of the government does not show a lot of green projects, that means that this money might be cut, or the investor might not get a lot of returns from it, because it depends on the prerogative of the government year after year. How much money are they willing to invest in green energy? Maybe some new government comes in and their priority changes and they say that no, we don't want money in green projects now, we'll spend somewhere else. So because of a lot of these factors, it is not a very well, or it's not something that the investors are looking forward to, unfortunately. These are how the sovereign green bonds basically work. Again, the use of proceeds, as I said, for green projects only. There are certification and standards that are given in the public domain so that you can be rest assured where the money is going, and reporting is required. CAG, as we discussed, has been given the responsibility to audit the funds that are going into all of these bonds. These are the other countries that are issuing it. So one of the first countries that started to issue it was, interestingly, France. Then Germany has also issued a lot of it. There are other countries that are now starting. And now again, it's a very interesting situation, because you might think that money is required more in poorer countries, right? It is the developing countries that would need more money for these projects. Richer countries like France and Germany would already have this money, but that is not always true. Even if you do have money, you would really want more money coming in specifically for certain projects. And if it is available in the market, why not? The government would be happy to take it. France also is a very unique case. France and Germany, if you look at these are two of the countries that for a long time were nuclear powers, as in civil nuclear energy was developed through nuclear power plants. Then about a decade back, about a decade and a half back, if you remember, there was this problem in Japan, the Fukushima disaster, as you call it, where the tsunami in Japan had damaged a nuclear power plant and there were radiation from nuclear power plant. That meant that France and Germany thought that nuclear power plants are not that safe. So now what has happened is, in the past decade or so, France and Germany are actually shutting down their nuclear power plants, while the developing world like India is expanding our capacity of nuclear power plants. Germany, France are shutting down their nuclear power plant because they realize that it may not be that safe after what happened in Japan. Because they are shutting down their nuclear power plant now, to make up or to fulfill this gap that has come up in the renewable energy space, they are now having to establish a lot more renewable energy projects. So it is all connected to each other. As I said earlier, first there was a lot of focus on nuclear power plant, then the Fukushima disaster in Japan that told them that nuclear plants are not that safe, so now they are shutting those down, and they are moving now back towards more more other options for renewable energy. That is why they need more money. That is why they are now looking for expansion and issuing all these green bonds. So it's all connected to each, and that is why France, Germany, they have been issuing a lot of green bonds to raise money for all of these efforts. Now, if you understood this, let's see if you can answer this particular question. Read it carefully and decide what the answer has to be. Read this carefully. All right. If you need more time to read it, you can pause on this screen and read it again. Let me then discuss it. With reference to sovereign green bonds in India, consider the following statements. Number one, sovereign green bonds are issued by the Reserve Bank of India on behalf of Government of India to finance environmentally sustainable projects. No. The RBI does not issue these bonds. Again, we are calling it time and time again sovereign green bonds. So they are issued by the Government of India itself. So they are issued by Government of India. Basically, it is the Ministry of Finance under Government of India that issues this. RBI is helping it, so RBI is in a supporting role kind of a thing, but RBI is not issuing it. With the support of RBI, the Ministry of Finance under the Government of India, they are the ones who are issuing it. Second, the framework for sovereign green bonds 2022 excludes fossil fuel based projects and hydropower plants larger than 25 megawatts from funding eligibility. Is that right? See, obviously, fossil fuel thing has to be excluded, that is obviously right. But what about the hydropower plants above this size? Are they also excluded from here? Yes, they are. That's a very interesting scenario. If you look at hydropower, the first thing that you would think about hydropower is, yes, it's a renewable source of energy, but it's very interesting when you categorize or when you look into hydropower plants, you basically categorize them into large and small. Large hydropower plants are not really in the category of renewable energy, because it is understood that for running of these power plant, that is the hydropower plant which is of huge size, you have to build them in such a manner that you are harming the environment. So it's not that renewable energy. It's a very interesting kind of a categorization where the large hydropower plants are not really considered to be sustainable, environmentally sustainable. The smaller ones are. So second is actually correct. Second is actually correct, that both of these are actually kept away from the money coming in from green bond. That is, the money that the government is realizing from green bond cannot be issued for any of this. Third, foreign institutional investors, FIIs, were permitted to invest in sovereign green bonds without restrictions starting from Jan 2025. That is also correct. Again, the government wants the money to come in, even if they come in from other ways. So the government wants that even if foreign institutional investors have to bring money or buy these bonds, they can. There won't be any restrictions on them. Economic Survey 24-25 reports sovereign green bonds have raised 53,000 crore since their inception in 2023. Now, it's a tricky statement here because there are certain reports that have highlighted that this much money has been raised by sovereign bonds, yes. But Economic Survey does not talk about that. This is not the source. So there are some sources, there are some multiple reports that are coming in. If you Google, you may find these reports that yes, the government may have raised this much money because of government bonds, but the Economic Survey does not say this. So that is why the fourth statement would be wrong. Now, 2 and 3 are the only ones correct, so the answer here becomes D. 2 and 3 are correct, D would be the answer. Slightly tricky. Do read this and understand this, because these kind of questions are asked by UPSC very regularly. Okay. Got it? All right then. Moving on to the next one. Read this carefully. See if you can answer this question. Take your time and read all the statements very carefully. This is important. If you want more time, maybe you can pause on this screen, think about what the answer should be. And again, reminding you, this is asking you which of these is not correct. So don't overlook this word. You had to tell which of these is not correct. Okay. All right. Consider the following statements regarding sovereign green bonds and their impact in India. Number 1. The proceeds from sovereign green bonds are deposited into the Consolidated Fund of India and are audited by the CAG. See, this part, that is audited by the CAG, we did discuss. But did we discuss this part? The money that comes in goes into Consolidated Fund of India. We did not discuss it, but that is true. The money that the government is collecting in the form of sovereign green bonds will go to Consolidated Fund of India, because this is where the government, whatever expenditure the government does, the budgeted expenditure goes out from the Consolidated Fund of India only. So when the government is making all this expenditure from Consolidated Fund of India, the money should go in there only. So it goes to Consolidated Fund and it is audited by the CAG. Second, first sovereign green bonds issuance in Jan 2023 achieved a greenium, indicating lower borrowing costs compared to regular government securities. Yes, we did discuss this, that the government that is issuing these bonds, the bond yield, the bond rates that are offered are lower. So when it is lower, that means if you think from the side of the government, from the side of the government, it is better, right? Because the government is using this to raise funds or to raise loans at a lower cost as compared to earlier. If the government would have to pay a higher bond yield, that would mean that the government's cost of borrowing money is increasing. But if the government is getting money at a lower rate of interest, that means it's better for the government. So second is correct. Third, RBI's draft rules in 2024 mandate that sovereign green bonds to be listed exclusively on National Stock Exchange for trading purpose. No, that is not true. For trading purpose, they can be listed on other stock exchanges as well. See, India has multiple stock exchanges. We don't just have National Stock Exchange, we have the Bombay Stock Exchange, we have other stock exchanges as well. So it doesn't have to be listed on this exchange only. As I told you earlier, the bonds or these bonds are tradable. So if you have bought it, you can trade it, but it doesn't have to be only on the National Stock Exchange. That is no requirement. Fourth, as per RBI's financial standing or financial stability report, December 2024, sovereign green bonds have significantly reduced India's reliance on external climate finance. Now think about this. Let's say we don't know this, but let's think this through. We discussed the fact that the government has been issuing the sovereign green bonds. However, the government unfortunately has not been able to raise a lot of money. Now, if the government has not been able to raise a lot of money, would you think the government's reliance or the government's dependence on the foreign money coming in would reduce? No, it would not reduce. It would only reduce if the money coming in from sovereign green bonds would be good enough. But right now, the government has not been getting a lot of money from these bonds. That is why it's not that we don't rely on foreign funds, we are still dependent on them as well. So third and fourth are wrong, and since you have to tell which of these is not correct, the answer here would be A. Okay, the answer here would be A. I hope you got this one right as well. These are the kind of questions that you can expect in the prelims examination with respect to topics such as the sovereign green bonds, the one that we have. If you want, you can take a screenshot here. It will be helpful for your revision as well. All right then, let me show you a related previous year question. Let's see if you can answer this. It's related to government bonds only. Let's see. Read it carefully. The Indian government bond yields are influenced by which of the following? So the bond yields, that is the money or the interest rate that will be offered on the government bond yield or the government bonds in India, is influenced by what? First, action of the US Federal Reserve. Does it influence our Indian bond yield? Yes. Why? See, if the US Federal Reserve increases their interest rates, means they make it more attractive for investors to bring the money back to the US. Any increase in the interest rate by the Federal Reserve means a lot of money will go out of India into the US. Now, to bring them back into India, we have to make it more attractive for them to bring their money back. How do we do that? By increasing our own bond yield. So our bond yield has to be increased because we have to attract the money back from India, from US, after they have increased their interest rate. So yes, that does have an impact. Action of Reserve Bank, yes, as I discussed, Reserve Bank does decide the liquidity in the market on the basis of which they will be able to determine whether the bond yields are higher or lower. Inflation and short-term interest rates, yes, again, because for an investor's point of view, they will have to see whether the bond yield that we have is beating inflation or not. If inflation in the country is 7%, 8%, and the bond yield is only 2-3%, why would anyone buy the bond? So government will have to improve the yield. Government will have to make it more attractive for people to buy the bond. So all these factors have an impact on the bond yield of the government. All of these decide whether the bond yield will be lower or higher. The answer thus would be D. All of these will have an impact on how the bond yields of the Indian bonds, the government bonds, are decided. D would be the correct answer here. If you want, you can take a screenshot here as well. Got it? All right then. The next topic that we have here is called the payment banks. Now, what are payment banks? What exactly is it and why is it in the news? So, first of all, it is in the news because of certain new regulations about payment banks. Second of all, what exactly are payment banks? Let's try and understand that. So the RBI has been trying very hard over the years to bring as many Indians into the banking system as possible, as in to ensure financial inclusion, that as many people should have bank accounts as possible. The government did a great job with something called the PM Jan Dhan Yojana. The PM Jan Dhan Yojana got 50 crore accounts opened. Now, what has happened is it's not just about how many people are opening the accounts. It is also about whether they have banks nearby them for banking services to be offered to them. Because even if someone opens up their bank account but they don't have a bank in the vicinity, they don't have a bank nearby, then there's no point of it. So a few years back, there was a committee that was formed called the Nachiket More Committee. The Nachiket More Committee specifically focused on the fact that we don't just need the common commercial banks that we have. So the universal banks, as they are called, the traditional banks that we have, like SBI, HDFC, PNB, etc. These are not enough. We need certain other banks as well that are specialized on certain purpose. Means we need certain banks, for example, that are specialized for, let's say, you only will look into small payments, you will not give any loans, you will only look into requirements of daily wage workers that have to send the money back to their houses, something like that. So Nachiket More Committee suggested that we have to open up different types of banks. Under that committee's report, there were two new kind of banks that were set up later on. First is what is called as the payment banks. So we have payment banks in India, and then we also have something called the small finance banks. Small finance bank is something we'll discuss a bit later, maybe tomorrow. But payment bank is something we'll discuss here. Now, what exactly are payment banks? Now, you might have heard about Paytm Payment Bank, Airtel Payment Bank. So there are a lot of payment banks in India that have emerged. As the name suggests, payment bank is specifically made for these payment related services. These are banks that do not have all the powers or all the functions of a bank. They can do certain things and then they are restricted to do certain things. I'll tell you what. The biggest issue with the payment banks is, think about how the banks earn their money. How is it at HDFC, ICICI, SBI, Axis, how do they earn their money? They earn money by giving out the loans to the people. So the loan that is offered by these banks, the interest that they charge on those loans, the fees that they take along with that, that is the major earning of the bank. With payment bank, however, the problem is the regulation of the payment bank says that payment banks cannot give out loans. That is a big issue. So their earning potential anyways is restricted, meaning that they cannot give out loans. And when we say they cannot give out loans, means they can't even give out any credit card, because see, credit card also is a kind of a loan only. When you give out a credit card, that's a kind of a loan, because what you are saying is, take this money, spend it, you can return it to me at a later stage. I don't really mind that. I will give you some time period. That is a kind of a loan only. So payment banks, the first important difference that they have as compared to other banks, number one, they can't give out loan or they can't even give out credit card. Second problem is their deposits also are restricted. The RBI has said, or the rules of payment banks are, that they can only have up to 2 lakh in an account. So if you have an account in the payment bank, there is a limit to how much money you can keep there, that is 2 lakh and not more than that. This basically limits the earning potential of the bank. So while a lot of companies took licenses and they are running payment bank, but the problem, as I said, is that their earning potential is quite restricted. Now, we'll go into more details of it, but let's see the background of it. Now, what do you have to remember? The first thing that you have to remember here is which committee recommended suggesting or setting up these banks. That was a Nachiket More Committee. This is important because in the past there have been multiple important committees set up suggesting different things. So don't be confused with that. For example, there is the Urjit Patel Committee. The Urjit Patel Committee of 2014 was the one that led to the establishment of Monetary Policy Committee of RBI. So the Monetary Policy Committee, or the MPC, the 6-member committee of the RBI that decides about the policy rates of the RBI, that committee was set up on the recommendation of the Urjit Patel Committee. Similarly, here if you see the small finance bank or the payment bank, for example, they have been set up on the recommendation of the Nachiket More committee. So don't be confused with that specifically. This is a part of, again, the idea was to have financial inclusion, to allow more people to come in the banking framework so that they are a part of this financial inclusion initiative by the government. The point of the payment banks is that they only offer a limited range of banking services. Now, why is it that RBI would not allow them to give out loans? Think of it from that point of view. Because we discussed that giving out loans is the biggest earning potential, it is the biggest earning opportunity for the banks. So why would the RBI tell them that no, you can't give out a loan? Because see, when the bank does not give out a loan, that means there are almost zero chances that something wrong will happen with the bank. Think of it. Why do the banks fail? The banks that fail, they fail because the money that they had given out in the form of loan is not being paid back to them, right? They turn into NPAs. We discussed about NPAs yesterday. NPA, special mention account, remember? So when the banks turn into NPAs, when the loan that they gave out turns into NPAs, that is when the banks go bad. That is when the scams hit them. When you have a bank that is not giving out a loan, that means there are almost zero chances that your money will go anywhere. The second point here is, but if you are not allowing the bank to give a loan, how will the bank earn? Well, ultimately, when the people are giving money to the bank, depositing in the account, they have to earn some interest. How will the bank earn? How will the bank give them some interest? This is where the payment bank specifically, for example, is told that most of the money that you get has to be invested in safe instruments such as government securities. So at least 75% of the money that you have has to be given in the form of, you have to buy government securities from that. So it is doing two things for the government. One, it is doing financial inclusion. Second, government has a buyer for its government securities, means the government will have a lot more options to take out funds or to get funds. That is where the government is actually doing this. So as I said, there are different types of payment banks. We have the Jio payment bank now, the Airtel payment bank. All these payment banks exist now in the country. The Indian Post, that is the post offices, their network, they have also been converted into kind of a payment bank. So Indian Post or the Postal Service anyways offers banking services. They used to offer banking services for a very, very long time. Now they have been converted official to payment bank as well. These are the aspects of how a payment bank is different as compared to traditional bank. All these points are important, so you must remember these kind of questions on payment banks are asked. So let's see what are the differences. First, as I said, they are limited to accepting demand deposits only, remittance services and ATM and debit cards. So demand deposit, as we discussed earlier, there are two types of deposits in a traditional bank. There is a demand deposit and there is a time deposit. Demand deposit means I give the money, let's say in my savings account. Whenever I want, I can demand the money to be given back to me. That is a normal account, that's how it works. You have the ATM card, you go and swipe the ATM, the money can be taken. You issue a check, you can withdraw the money. So that is your money, you can demand whenever you want. Then there is something called a term deposit. Term deposit with the normal banks can do are, for example, fixed deposit, that I have given the money to you for 10 years, 20 years, and then after 20 years, I will come back to take my money. That is not something that the payment banks can do. Then they can't offer loan, or even credit card can be offered, because credit card also is a kind of a loan. That is to reduce their risk. Their risk is minimized because of this aspect. The deposit limit again is set at 2 lakh per customer. They cannot be more than 2 lakh deposit in a bank account, in a customer's bank account. Mandatory to invest a significant portion in government security. This is where the government likes it. Because see, for the government securities or government bonds are the easiest way to get money for the market. The government, as you know, year on year, our governments run a budget deficit. So every single year, the government of India, for example, earns lesser than what we spend. We spend more money than what we earn. So every year when you have that deposit, when you have that deficit, your expenditure is more, your earning is less, the gap between the two has to be financed, has to be fixed by someone. Someone has to come in between and say, okay, we are giving you the money. Who does that? This is where the government takes money from the market, especially in the form of government securities. So government will issue these securities, and when the government does not find any buyers, that is when the government forces the banks to buy it. So in the form of payment banks, they now have one more option where they will be kind of forced to buy government securities, so government will have access to more money. Lower risk. See, nothing is zero risk. You can never say zero risk, because if there has to be a scam, the scam can mean anything. For example, let's say most of the money you gave in government security. What if the government security itself fails? What if the government is not giving the security back? What if the government goes bankrupt and say that, oh, we can't give this money back now, we don't have money remaining? Anything can happen. So in system like banks, you can never say zero risk. So always go with minimal risk or reduced risk. Target customers are those who don't have a banking account and they run very small businesses, especially as I discussed for remittances. So remittances, for example, let's say there is a person from Jharkhand who is working as a laborer in Kerala or Tamil Nadu. So whatever they are earning, a part of it they have to send back to their village in Tamil Nadu. So what do? This is where they can transfer money to their account, and the bank will transfer the money into the local account there. Operational areas, mainly rural areas and semi-urban areas. You would not find these kind of banks, for example, in big cities. In metro cities, you will not find these banks. These are banks that are mostly operational in those places where other traditional banks don't exist, so that they can have that unbanked people, that clientage is attracted. Capital requirement means how much capital do you need to start this bank. Now the RBI decides that. For a long time, a new traditional bank has not opened, but earlier, when the new traditional banks or new common banks used to be opened, for example, RBI used to say you should have at least 500 crore rupees to start the business. For payment banks, it is 100 crore rupees. This is the minimum paid up capital that you need to have. Out of this 100 crore, promoters must contribute at least 40% of the paid up capital equity. Now, what do you mean by promoters? Promoters are the people who start a company. You can call them founders, you can call them by whatever name that you want, but promoters is the technical word here. So promoters are the founders, the owners of the company who started this. So 100 crore is the money that has to be pooled in to start this bank. Out of that 100 crore or out of whatever capital you have, at least 40 crore should be from the promoters only. Paid up equity means in return of that they would have or they would own a percentage of the bank. So if out of, let's say, 100 crore, they are bringing in 40 crore, means 40% bank is owned by them. If they bring 80%, means 80% bank is owned by them, depending upon how much money do they contribute. On the other hand, this is how the traditional banks work. They offer all the services that you usually associate with the banks, giving out loans, giving out credit cards. They have their operational areas are both urban, rural, metro cities, everywhere they are present. For these banks, traditional banks, it depends on the RBI. When the RBI is rolling out licenses, they will decide what should be the capital. But there is no fixed capital right now, because again, it has not happened for a long time that we have had new traditional banks. When it does open, then we will see what the minimum paid up capital would be. But it is obviously going to be much bigger than what the payment banks are expected to have. Now, payment banks regulations are these. These are important because these are slightly different as compared to traditional banks. For example, if you look at the payment banks, they are registered as public limited companies under the Companies Act. Even then, they are regulated by the RBI. Not just by the RBI, they are also regulated under the FEMA, that is Foreign Exchange Management Act, and other related laws. They also have to maintain a cash reserve ratio. So unlike, just like the other banks who have to keep a set of money or a bunch of their money in cash with the RBI at every point of time, they also have to do that. You should know that the money that the banks keep with the RBI, that is in the form of cash reserve ratio, the banks are not earning any interest on that. So that is kind of a money that is losing its value because inflation is rising, but even then the banks have to deposit this much money with the RBI. That is again the RBI's method to keep the banks safe. What if there is a situation in the future when you suddenly see a lot of significant losses, when suddenly your NPAs increase, so you should have some money as a backup with you to help you safeguard against those damages. This is what the RBI does. Please remember, there is no interest paid against this by the RBI, the money that they are keeping of the banks. Then they have to invest about 75% of their demand deposit balance in SLR eligible government security. This is where the government is very happy with it. Out of all the deposits they have, that is the only way in which they can actually earn the income. At least 75% has to be spent in buying of government security, so that the government also has buyers, the government also has these things available. Remember, we just discussed in the last topic, the sovereign green bonds. When the banks buy sovereign green bond, that is counted as a part of their SLR norms. So this is where it also applies. Payment banks also, 75% of their money has to be used in buying of these government bonds, so they can buy these sovereign green bonds as well. It serves a similar kind of a purpose. So this is how the payment banks will have to operate in the country. Now, payment banks or small finance banks, they come in the category of what we call as differentiated banks. Again, the idea of differentiated banks is the banks which are set up for a specific purpose to be served. These are banks for specific purpose, like the payment bank is not a traditional bank, because a traditional bank will not tell the customer that no, you can't deposit more than 2 lakh. A traditional bank will offer loans, they will offer credit cards, but payment banks can't do that. Then there are small finance banks also that we will study later on. These are called differentiated. Differentiated in the sense that they have a specific target given to them, a specific mandate has been given to them, that these are your customers, these are your areas where you will have to focus on. You don't have to compete with other traditional banks. This idea of differentiated banks is something that came up in 2013, and again I've told the name of the committee earlier. It was a Nachiket Moore committee that suggested this, that you have to ensure that these are the kind of banks that are opened up. Now, think of it from the point of view of, let's say, a company or a businessman. Let's say you're a businessman and you see this ad of the RBI that do you want to open up a payment bank, contact us. Why would you open up a payment bank? Because see, they don't have a lot of earning potential. The biggest earning potential the banks have are through the loans and the credit cards. So if they don't have that option available, they don't have the option to give loan, to give credit card, in that scenario, why is it that someone would apply for a license? In most of the cases, when the companies applied for the license, the reality is the companies applied for that hoping that when they get an experience of few years, they can convince the RBI to then convert that into a traditional bank. That was the hope. No promises were made, but the hope was, see, in India today, even today, having or owning a bank is extremely lucrative. You can earn a lot of money if you own a bank. So the idea here was that eventually they wanted to make sure that they convert into a full-time traditional bank, and that is why a lot of companies opted for this. But none of the companies that opted for this payment bank, the Airtel or Paytm or Jio, are very happy or making a lot of profit here. The idea is that it's more of an investment, so that it translates long-term into a traditional bank setup from where they can earn more money as compared to others. This is again the differences between payment bank and small finance bank. Payment bank we have already studied, but if you look at the small finance bank, for example, they are slightly different. So small finance bank, they were set up again similar kind of a purpose, but there were slight differences here. Like in a small finance bank, they can give out loan, but their loans, for them, 75% of loans have to be for priority sector. As you know, priority sector basically are those sectors where the government wants to give a push for more funds. For example, agriculture, education loans, home loan for affordable housing, where the government wants to give more push to money coming in. That is called priority sector. That's under priority sector lending. 75% of their loans have to go there. 25% branches should be in unbanked areas. So there are slight differences between payment bank and small finance bank. This is a separate topic altogether that we will study later on, tomorrow most probably, when we come across this particular topic of the small finance bank. If you understood this, let's see if you are able to answer a few questions here. Read it very, very, very carefully and think about the answer, lock in your answer in your mind, then we can discuss. Done? If you have read it, perfect. If you still need more time, maybe you can pause on this screen and then think about your answer, and then you can play after that. Okay, let's see. With reference to payment banks in India, consider the following. First, payment banks are licensed under Section 22 of Banking Regulation Act 1949 and are designated as scheduled bank by the Reserve Bank of India. That is correct. They are called scheduled banks. They are registered under the Banking Regulation Act. So they are formed under the Banking Companies Act, but they are also registered under the Banking Regulation Act here. Second, they are permitted to undertake lending activities. No. The moment you say lending activities, that becomes wrong. Because the entire point of payment bank is that they cannot give out loans, they can't even give credit cards, so no lending of any sort, small, large, doesn't really matter. The minimum paid up capital requirement for payment banks is 100 crore rupees, with promoters required to maintain at least 40% stake for the first 5 years. We discussed about this. 100 crore paid up capital means at least 100 crore has to be the money that they have with them. Out of that, 40 crore has to be from the promoter side. What we did not discuss was this part. For the first 5 years means within the first 5 years, the promoters, owners can't say that, oh, now I'm selling my stake, I'm going away. No. RBI has kind of kept a lock in that for the first 5 years, your money will be locked in here, because it can't be a business where you set up the bank, you gave your credentials, you took the license from the RBI, and then after taking the license, when the bank starts, in a few months you sell it off and go away. No. The RBI gave the license based on your credibility, so you have to be attached with it for at least 5 years. That is again correct. Last, as per RBI's Financial Stability Report, December 2024, payment banks accounted for over 20% of digital transactions by volume in FY 2023-24. No, there is no such data available that 20% of these digital transactions were from this bank. No, that is not true. Anyways, they don't account for so much digital transactions anyway, because think about it, the people that they are promoting or the people that they are targeting as their customers are those that are unbanked, that don't have banking experience or they don't have a bank account. So you don't expect that population to have a lot of digital transactions anyways. So fourth is wrong. 1 and 3 are correct. The answer here would be A. A is the correct answer here. Okay, 1 and 3 here are correct. You can take a screenshot from here if you wish to, for your revision purpose. Got it? All right, let's see if you can answer the next question here. Read it carefully again. It's an important question. Read all the statements and make up your mind, and also do pay attention here. Done? Read this? Understood? Okay, if you need more time, feel free to pause on this screen and then decide your answer, lock in your answer, and then you can play it again. Consider the following statements regarding payment banks and their role in India's financial ecosystem. First, payment banks can accept demand deposits up to 2 lakh rupees per customer, insured by the Deposit Insurance and Credit Guarantee Corporation. Absolutely correct. What exactly is DICGC? So this is an organization that actually kind of an insurance company for the banks. So when so many people deposit their money in the banks, there is always a chance that something might go wrong. That is why on a personal level also you take insurance, you take health insurance, you take other types of insurances to deal with such situations. Banks also, for a similar purpose, take insurance, or they have to take insurance from DICGC. It's a government, RBI owned entity rather. They will be the one who will actually be giving, or who are actually ensuring the bank accounts of everyone who has a account or who have deposited some money here, so that if bank goes bankrupt, there is at least some amount of money that you will get. This is your homework. In fact, search about this and tell me in the comment section up to what limit does it reimburse the person? So if let's say you have 1 crore rupees in a bank account and the bank goes bankrupt, they say I don't have any money left. In that case, how much money will the company give it back to you? The insurance is up till what limit per account? It's an important number. Recently it was increased as well. Search about it, let me know in the comment section. This is your homework. So first is correct. Second, they are allowed to issue credit cards in partnership with commercial banks under a co-branding agreement. I just discussed they can't issue credit cards. No loans, no credit cards, credit of any kind, because credit card also is a kind of a loan, so they can't issue that. Nachiket More Committee 2014 recommended creation of payment banks to enhance financial inclusion for low-income households. We have been discussing this. That is absolutely correct. They discussed or they suggested that especially in those areas where we don't have banks or where people don't have bank accounts, these banks can be helpful. As per Economic Survey 24-25, payment banks have facilitated a 30% increase in rural digital banking penetration since 2020. No such data has come out. Again, as I told you earlier, if you are considering their market or they are considering their customer base, rural India, especially people who have not had a bank account, you would not expect a lot of digital transactions to happen there. So this data anyways has not come out, that how much of digital penetration has happened because of these banks in rural India especially. You have to tell which of these is wrong. Fourth is wrong and second was wrong. So the answer here becomes A. 2 and 4 only are wrong. The other two statements are correct. A would be the correct answer here. Okay. If you wish, you can take a screenshot from here. Done? Okay. Now I have a previous year question related to this. In fact, especially related to or especially on payment banks, there was a question asked by UPSC. Think about this. Not a difficult question. If you have understood this topic, you should be able to answer this. Read this. If you need more time, again pause on the screen, think about what the answer should be, and then you can play again. Let's discuss. The establishment of payment banks is being allowed in India to promote financial inclusion. Which of the following statements is or are correct in this context? It was a very in the news question. It was asked in 2016. This is when the banks were just set up. So it was very important from that year's perspective especially. First, mobile telephone company and supermarket chains that are owned and controlled by residents are eligible to be promoters of payment banks. Yes. So very interesting part was that you do not have to have a banking experience. Like with small finance banks, the requirement was that the promoters who are applying for license should have had a banking experience, should have worked in the banks at high level, should know the working of the bank. In this case, telecom companies, etc. Because why? See, these companies were the ones who actually know the rural market. And the idea was that in rural India, people would have heard about them. They might connect with the brand name. That is why Paytm, Airtel, Jio, these applied and they became payment banks. Second, payment bank can issue both credit card and debit card. What have I been discussing multiple times? They cannot issue credit card because again it is a kind of a loan. So nothing like a credit, nothing like a loan can be issued. So debit card, yes, they can issue debit card because see, when someone makes a demand deposit as in when they have deposited money as in the savings bank account, then obviously you can take that. You would have to issue them debit card so that you give them the right to withdraw the money. Credit card, no, because it will be a kind of a loan and that is not permitted from the side of the payment bank. Third, payment bank cannot undertake lending activities, exactly what we discussed. They cannot take in lending activities, that is why their earning potential is quite limited. 75% of the demand deposit that they have to be used in buying government securities. That is the only way in which they can earn some money. 1 and 3 are correct. The answer thus would be B. So B is the correct answer here. Second one here is wrong. This was a straightforward question about payment banks in 2016. If you want to take a screenshot, you can. And you can revise it later on as well for payment banks. Alright then, this brings us to the end of today's session. This was session number 11 of economics in our ongoing prelims crash course. I really hope that you have attended all of these. In case you have missed out on any of the earlier classes, go to the playlist. All these videos will be lined up here for you. Do have a pen and a paper with you so that you can also keep answering the question that we discuss here. These are extremely vital for you to help you prepare for the prelims examination that is just about a month away. We have 3 more classes to go for economics. We also have classes of other subjects on our YouTube channel specially designed for those who are writing the prelims this year. We have the Indian economy, Indian polity classes going on. We'll be starting with other subjects as well very soon. So do stay tuned. If you're new here, do hit the subscribe and the like button so that we can know that you are attentive here. Share this with your friends as well, and do watch us tomorrow. I'll be here live once again at 12 tomorrow. My name is Harshmeet Singh and we are here from Narayana IAS Academy. Thank you so much. Bye-bye. Jai Hind.